I would like to extend a warm welcome to everyone. Thank you for joining us for today's recorded webinar on Unlocking Transformational Value through SIOP. I'm Joanna Sirkowski, the moderator for today's session. We have approximately 45 minutes set aside to discuss SIOP, or Sales, Inventory, and Operations Planning. The first 30 minutes will be a lively discussion about SIOP. The last 15 minutes we have set aside to answer your questions. Please enter questions via the Q&A panel, and we will address as many as possible. A recording of this webinar will be available on the Trivista website shortly after this session. As you leave the webinar, you will be asked to complete a brief survey. Please just take a minute to give us your feedback, as we greatly appreciate your thoughts and comments. With that, let's get started. We are all in the business of maximizing return on investments. One of the highest return on investments in the lower and mid-market space is SIOP. To discuss unlocking transformational value through SIOP, I am joined by two of my colleagues and operational practitioners, Scott Sparks and Philip Lee. Philip has more than 20 years of industry experience in both finance and supply chain management. He was responsible for SIOP at several operating companies before joining Trivista. Philip has helped numerous Trivista clients across the manufacturing and distribution sectors increase their EBITDA through SIOP improvements. By combining a highly analytical approach with his understanding of working in an operating company, Philip can effectively deliver the right size implementation plans that deliver the desired results. We are also joined by Scott Sparks. Scott has 25 years of business strategy and operations experience gained through industry roles at Fortune 500 firms and in top-tier strategy consulting firms. Scott oversees Trivista's supply chain practice, and his team is focused on several things, including optimizing manufacturing, distribution, and transportation operations, consolidating, relocating, and improving facilities, reducing costs through sourcing and procurement best practices, and improving market responsiveness through more effective inventory and operations planning. Scott is recognized as an expert in supply chain strategy and operations management. The goal of this webinar is to share details on several key SIOP topics, including signs you may have an SIOP-related issue, insights on why SIOP is often underdeveloped in lower and mid-market companies, understanding of how SIOP improves profitability, working capital, and customer service, steps for how to diagnose an SIOP opportunity, and requirements for standing up a mature or transformational SIOP system and the typical results of those improvement efforts. With that, I'd like to turn the discussion over to Scott Sparks to get us started.
Thanks, Joanna. Let me give you a quick background to start. As Joanna said in her opening comments, we spend most of our time working with PE firms and management teams of portfolio companies, figuring out how to improve the value of mid-market manufacturing and distribution companies. Over the past 3 or 4 years, we have found that the answer, more often than not, is that SIOP rises to the top of the list as one of the longest levers to improve financial and operational performance. So why is that? The answer is that it's a number of things. First, SIOP really is the heartbeat of a company. It's the capability that allows the management team and PE partner to know with confidence that the AOP, or revenue and profit plan for the company, is going to happen or is real. SIOP is the thing that links the financial plan and value improvement plan to realize results in the P&L through a very specific set of actions in the guts of the manufacturing or distribution operations. Without it, it's almost impossible to have this clarity that aspirational financial targets will actually be realized. And then at a more granular level, SIOP is a revenue driver. It's the set of processes that are absolutely required for any company to consistently deliver its products on time and to maintain its target customer service level, which in most industries is a major driver of customer satisfaction and ultimately of revenue. But it's not just a revenue driver. SIOP results in the minimum amount of material and finished product inventory that's required to meet your service levels. So when we work with companies that don't have strong SIOP processes, we always find significant one-time cash benefit from inventory reduction and ongoing EBITDA improvement associated with the cost of carrying and handling all of that excess inventory. And then finally, SIOP drives EBITDA margin improvement for manufacturers through manufacturing direct labor productivity and manufacturing capital utilization. It's the planning engine that ensures you're loading your factory appropriately so you don't underload and end up with idle direct labor and poor overhead absorption, or overload and drive WIP back up, and all the related labor and inefficiency issues that go along with that. So in summary, SIOP pulls all of the EV improvement levers: revenue lift, EBITDA margin improvement, and capital efficiency. So how do you address this opportunity and get to the value improvement potential? Rather than taking a bottom-up approach to try and give you the technical details or gaps to look for in the guts of a broken SIOP machine, we're taking a top-down approach. We know that when certain business symptoms are in play, there is an SIOP opportunity. We found this is a much simpler way to assess opportunity without having to understand the technical nuances of how SIOP works. So let's jump into it and start by asking Philip, what are the telltale signs that gaps in my SIOP processes may be a real driver of some of my bigger operational and financial issues?
Thanks for the question, Scott, and thanks to everybody on the call today. So first and foremost, as Scott alluded to, the number one sign that we've got a SIOP related issue is revenue and or profitability with respect to are we missing what we think it should be, and or is it hard to forecast or plan to in terms of, are we meeting what we thought we would get? That usually jumps out as the number one opportunity for a SIOP related issue at hand. Kind of more traditionally obvious items would be inventory that's growing, whether it's in a distribution environment or it's a manufacturing environment, just the growth of inventory and the decline of turns. Past due backlog that's starting to grow, on-time delivery to customers that's starting to get poor. And then maybe a little bit less obvious might be things like customers that are starting to squeeze the business for cost takeout in a B2B type environment. Or maybe the business not getting as many opportunities to quote on or to bid on high margin good products, and some of those opportunities are starting to fade away. Those would be kind of the telltale early quick signs that we've got something at play, something that's brewing, something worth looking at with respect to SIOP.
Yeah, it's interesting. There's so many common operations issues where SIOP could be at the root. You'd think that it would be easy to diagnose, but we find that so many of our clients misdiagnose these issues as coming from manufacturing productivity or warehouse productivity, things that they can physically see, and they overlook the intangible or the SIOP processes.
Yeah, like you said, SIOP is the guts or the glue that holds everything together for a business. Once they grow to a certain size and space, size and scale, you need to have some sort of a system or process in place that kind of holds all these pieces in parts together, holds individuals responsible, etc. Without that, it starts to bubble up, and we have all these underlying things that are starting to happen. And the natural thing is to look at, well, what can you see? What can you address? Based on what you can see or what somebody is telling you, not necessarily understanding that it might be a complete system-related issue that's not as mature or as properly developed as it needs to be in order to hold everything together.
Yeah, that's a great point. And also a good segue into our next question. If these signs of SIOP-related issues are so prominent, why is it that SIOP is so commonly underdeveloped, and in particular, in the types of companies that we're dealing with, smaller mid-market companies that we're inside of every day?
Yeah, so really good question, Scott, and we do see it all the time. And sometimes I feel a little bit bad for some of our clients because they're doing great, right? They're doing really good things. They've developed products or they've developed great customer relationships, and they've grown. They've been successful. They found favor with a private equity partner, for example, and they feel pretty good about themselves. And we come in there and we're looking at issues related to them trying to grow, and they're starting to fall down a little bit. And we have to go through this litany of things that aren't yet developed, right? And the reason for that is that really, in that emerging growth phase of a new business or a smaller business, say you're under 100 million or under $200 million, you don't really need to have some of those really key developed processes in place. For example, what you do need to do is you need to be able to sell really well. You need to be able to manufacture really well. And you need to have really good people around you, for example. And so maybe to just sort of kind of, give a timely, albeit a little bit of a silly illustration, let's assume, for example, that in a couple of weeks, you've got your holiday get together with mom and dad. They ask you to bring a turkey to the occasion for the family. So you're going to get a turkey. You're going to procure the turkey. You're going to prep it. You're going to cook it. You're going to package it up, and you're going to bring it over to the family for the dinner. We could all, any one of us on this call, could do this just through our minds. We wouldn't need a calendar. We wouldn't need anything, right? But effectively, you are, you're acting out part of a manufacturing process, if you will. Let's assume instead of that one turkey for mom and dad in a couple of weeks, instead you've got 100,000 turkey orders, right? You've got 40% of those orders are between October and December. You've got 2,000 ovens, you've got 10 grocery stores to procure this from, and you've got 40 drivers to package and deliver these cooked turkeys. Somewhere between the example of you bringing this to your mom and dad in a couple of weeks and this 100,000 order turkey business, if you will, something needs to be developed along the way. And whether that's at 20,000 turkeys or 40 or 60 or 80, we never exactly know when it is or where it is, but at some point, things grow beyond the ability for us to just manage something in our mind or in a simple spreadsheet or in a calendar. At some point, we need to have some system or some process in order to understand what are all the orders or opportunities that we have. What sort of existing capability, capacity, or supply do we have lined up? And do they match? Do they make sense? And can we deliver what we're promising to our customers?
Yeah, it's really interesting how often we see that point that you made earlier, that businesses at some point they reach an inflection point in their growth where the business complexity becomes so great that it's basically an important and fundamental requirement to run the operations efficiently. At some point, line of sight management just isn't good enough, and you need effective SIOP processes to run the operations and financially thrive.
Yeah, totally agree, Scott. And the thing is that's interesting is there isn't any predefined exact revenue level or asset level or profitability level. It's sort of a combination of how complex is the business itself in terms of like the bill of materials. Is it a 10-item bill of material or is it 200? How long are the lead times of the suppliers? Where are they being sourced from? What degree of complexity are those items if we're manufacturing, for example? How many assets do they run down? If we're in a distribution environment, it's where are we located? How many geographic locations do we have? How dispersed are we? It just depends. There is no exact answer. But at some point between being a $20 million business and usually about $150 or $200 million business, somewhere in there, things start to break down if certain systems with respect to SIOP are not developed.
Yeah, that's a great summary. So I think we've covered the why questions. Why is SIOP at the root of so many operational issues that manufacturers and distributors face? And why is it so frequently underdeveloped? So let's switch gears and talk about the how question, or how does SIOP drive the benefits that we've been talking about in profitability, in working capital, and in customer service?
Yeah, so basically the great part of the process, SIOP process, is that you get a preview when this is done correctly. You get a preview of what's going to happen before it actually happens, and it allows you to align the business and everybody interested or involved, on collaborating on how you actually want to perform. So, for example, when the routine is done in its proper form, a demand plan is developed, a view of what are all the future opportunities that the business has. And those opportunities are translated into what does that mean in terms of supply or the capacity necessary in order to fit that, or the inventory on hand that we're going to carry with respect to meeting those orders. And when we've got those two views together, if we're in a manufacturing environment, for example, what we can do is we can actually define the actual plan of production that's going to answer both the demand and the supply. And it's going to fit for us as best as we can, some sort of plan of future work, plan of future production, plan of future required labor and capacity, et cetera, that delivers or answers that. And each of these plans, oftentimes, a couple of them will be developed in a week 3 activity of a sophisticated SIOP routine. Each of these different plans will have different levels potentially of working capital requirement, of profitability, of service to customers. And the business then gets to sort of go through and decide, strategically, tactically, what is the best course of action for us at this point in time to go answer demand and supply, and have a predefined vision of exactly how we're going to transact. The great part of the routine also is, as a former finance guy, you also get the ability to project what that would be in terms of cash flow, in terms of profitability, in terms of all the things that you would want as an input into a really sound FP&A planning process. So it's a great way to understand what are all the opportunities, what do you have at hand, what are you going to do, and what does it mean to your P&L, to your balance sheet, and to your investors.
Yeah, that's really interesting. Thinking about your comments there, the world changes constantly. New customers come online with new expectations. COVID comes along and changes demand patterns instantly. Suppliers don't show up with their inventory or don't show up on time. And SIOP acts like this feedback mechanism that allows a company to adjust sales and operations to stay in sync with what's going on in the world constantly over time.
No, exactly, Scott. In businesses that get really good at doing this, it's sometimes called integrated business planning, where you're running this routine and almost in a strategic manner, where you are effectively creating the equivalent of a little mini AOP each month. And this is kind of a refresh of all your financial plans, of all your demand and supply plans and capacity plans, and you're getting really good, really nimble. So you really don't need to do an annual plan, because every month you are kind of refreshing it. And the beauty of this is that when you are doing this at such a frequent cadence, you get really good at actually starting to tease out the what if of what you could go after in the market. So let's say, for example, the demand plan that you're looking at, if you looked at it, the last couple of months, it's not kind of where you want it to be. But businesses that are really good at this start to look at, well, what should we be doing? Could we be doing something else? What, with this productive capacity that we have, that we've invested in, is there a different marketplace of opportunities we could potentially be going after? And these sorts of things are sort of stress test, trial and error, and simulated over time after iterants and iterants of a sophisticated SIOP routine. So it really becomes almost a little bit of a strategy driving routine, as much it is a strategy consuming activity, in the monthly cadence.
Yeah, thanks for that. So next question for you, Philip. Is there an easy way to diagnose an opportunity for SIOP improvement? And, we typically look at companies pre-acquisition and also post-close. So I'm sure there are differences to that answer depending on the situation.
Yeah, they are. And usually, in a pre-acquisition type of environment, we don't get quite as much time to really dig in. But we can usually tease out of a business a couple of kind of 5 key areas where we can sense and get a feel for whether there's a potential issue, and whether there's obviously some level of impact, financial opportunity that might exist with respect to the business. So, number one, is the business regularly achieving revenue and profit targets? Is it, high profitability per unit, revenue per unit, those types of things. We have a couple of different tests we can do in that environment to look at a business's revenue, its trajectory, its trends on that side of the revenue and profitability side of the business. We can also look at turns of inventory or inventory values themselves, or even inventory, the space it's starting to occupy. We can get a feel for, is there an escalation or a growth that's happening, which is usually an obvious sign that something is askew with respect to what we're planning to do versus what we're actually able to do. Something is a little bit broken along the way there. Customer delivery dates, a key and critical performance measure. One that sometimes businesses that are in the B2B space or in the make-to-order space don't take quite as seriously as the distributor does, or as the business that's servicing the CPG or the Walmarts and Targets of the world. But really understanding how are you servicing your customers from a request date standpoint as well as a promise date standpoint. And they each mean a little something different, but we've got tests and ways to calibrate and calculate where a business is performing with respect to that, and identify for them if they've got some sort of processes that maybe are not as developed as they need to be in order to be performing the way they could be, or could tell us if there's a a transformational opportunity and value with respect to the business. And then lastly, something that jumps up sometimes is employee turnover. So think about a business where you've got people showing up, direct labor, indirect labor, people that are actually creating the transformational value in the product. And every day they're being, told to do something different. At the same time, they're being asked to provide high OEE productivity. It gets really frustrating. And at some point in a low maturity SIOP type environment, these people start to get frustrated to the point where, after 3 straight weeks of overtime to try to go, make up for capacity that we didn't plan for in advance, people start to leave. And so that's another telltale sign that there's something happening in SIOP and the potential for some significant financial gain. And then lastly, I kind of skipped over the production itself, but a really, really key opportunity exists in understanding how production is happening. So think about an environment where production is happening in a regular cadence, and you're running the quantity of runs that are equal to what you quoted, or equal to what is your EOQ if you're fulfilling a distribution a warehouse position. And all of a sudden you're starting to run little tiny small runs, right? And you're breaking into existing runs with little small runs. These are, again, other signs that something isn't happening up front that allowed you to get to the place where you could have a stable, predefined plan of production in advance of when you actually, are at the point of producing. And what you're doing is you're reacting to some kind of a screaming need, a hot list of, a break-in, a customer, requesting line time, or screaming at you to hurry up and expedite something in order to get it to them. That's another big indication that we've got an issue. And for all of these, we've got various tests that we've done it over years, and we can rather quickly identify, where are the big issues, big opportunities, and what sort of is the impact or opportunity with respect to that level of SIOP immaturity, if you will.
So once you've got it up and running, what can you expect in terms of a range of financial and operational benefits?
So what we have posted here is kind of call it our median. We're going to be 3 to 15 on the revenue side, inventory 10 to 30% takeout, and then on EBITDA it's going to be 5 to 20. But we've seen countless opportunities where they were double and triple this, right? So I mean, just recently we completed a project where we helped out a business that was a aerospace defense contracting business. I think they were about $80 or $90 million. They had a capacity and a service related issue. We went in there, helped them understand where their demand was, gave them the ability to align that with their existing capacities, to kind of go through the routines of consensus, understand what you can and cannot do, ask customers to help out in the process, get a better view of where things were at. At the end of the day, the business completely transformed how they actually serviced that demand that they had. They weren't looking at it, in a long-term horizon in the past. Now they were capacity planning it, balancing it. They were aligning that with the customers, aligning it with the customers' expectations. The customers loved it. They hadn't seen this from this business ever, and they ultimately, were able to service the customers adequately. They were able to take the appropriate actions to have the capacity profile necessary to meet these particular orders. And what they had was this massive surge of new orders. So they had, basically it was an $88 million company that grew to $119 million inside of 18 months. Their EBITDA doubled. And it was all, it was an issue related to capacity, an issue related to service. And what it ultimately ended up being was this massive transformational revenue in EBITDA lift transformation for this business. And we see this all the time. Businesses don't necessarily understand how much business their customers want to give them until they fix those issues with respect to servicing their customers adequately and appropriately.
Yeah, that's a great example. It's really interesting how inventory savings are commonly the entry point in SIOP improvement for so many of our clients. There's one client right now, an industrial products distributor, where the total inventory reduction is about 30% of what they're holding. And then earlier in the year, there's another larger manufacturer, almost mid-cap size manufacturer, where we found over $100 million in near-term cash benefit through inventory reduction. But when you take the gloves off of the supply and demand balancing routines in SIOP, you really do see much broader benefit on the revenue side of the equation.
Yeah, no, you're absolutely right, Scott. And I think it's worth mentioning to everybody. I mean, when we talk about what you would need to do to go stand up some of this stuff in SIOP, it isn't, a massive integrated ERP. It isn't some really expensive, software. It really is a lot about taking some existing templatized forms and things that others have done. I mean, I ran sales and operations planning for a $1.5 billion company with 22 manufacturing sites, 250 lines of manufacturing on Excel, right? So this isn't, we're not talking about, a $1 million SAP or $10 million SAP platform. We're talking about just being able to understand, and organize what is the opportunities you have, what are your existing capacities, putting them together and having a routine and alignment that can really confirm that all the different pieces are flowing, are correctly communicating with each other, and that we've got consensus and alignment on where we're going and what we can actually do.
Yeah, thanks, Philip. That's a great summary and a good point to end on. So we've talked about how important high-functioning SIOP processes can be in the financial and operational performance of mid-market manufacturers, distributors, and consumer product companies. We've also talked about how SIOP really is the mechanism for tying aspirational revenue and profit targets for the year down to specific activities in the guts of the company to ensure that they're realized. And we walked through a number of the signs and symptoms of an underperforming SIOP process and how easy it really can be to get to the root of the problem. And finally, we highlighted a few of the important financial benefits once you put the solution in place. So Joanna, let's turn it back over to you to manage the Q&A portion of the webinar.
Yes, thanks, Scott and Philip. We'd love to answer your questions. As a reminder, please use the Q&A panel feature if you would like to submit a question for Scott and Philip to address. We'll get to as many questions as possible in the next 10 to 15 minutes.
Philip, for clients that we work with that already have SIOP processes in place, where have you seen their process fall short? In what areas?
So I hope this is working correctly and you can hear me okay, everybody. But generally what we see is that, if a developed SIOP process is in place, usually the businesses take hold. They love the process, they love the routine, they love coming together, breaking down barriers in silos. But sometimes there is, unfortunately, a little bit of a concerning aspect of this, which is that in a business that is a little bit siloed, sometimes for some reasons, some senior leadership generally will tend to prefer or like the fact that they're not held responsible, if you will, for all of the decisions being made. In the routine in SIOP, what it ends up doing is, like I said before, in kind of your week 3 activity, you get a preview of what are your options that you can take over the course of the next several quarters or the next year. And sometimes that means some people are going to be disappointed. It could be a disappointment to your employees that now are forced to run a 24/7 operation with overtime. It could be resulting in some customers now that are not going to get the same level of service they used to get in the past. And we've decided that D-level customers are only going to get met at 80% or 60% of where they used to get met, et cetera, et cetera. When this routine is done the way it's supposed to be developed, there is an alignment around what are the puts and takes with respect to where we're going in the future. And everybody gets aligned on that. And usually, ultimately, there's a tough call that has to be made by senior leadership. And sometimes they're not that comfortable or happy making that call. So in my opinion, in my history, the only times I've ever really seen this process fall down is when senior leadership is not behind it, or when they prefer being able to hide a little bit, behind what sales is doing or what manufacturing is doing, and not really standing up and being that great leader that the business is asking them to be.
Great, thanks, Philip. So Scott, which supply chain processes are included in the overall SIOP solution? So in other words, which processes need to be modified to work within an overall SIOP solution?
That's another great question. The way we came at this was, we came at it from a top-down viewpoint. A lot of times you'll see people come in and start digging in to explain what SIOP is from the ground up. Which exact processes have to change? What are those? I think it's very, seemingly complex. So we try to come at it from top down. But in doing that, we realized that we probably did skip over some of the, sort of the core portions of SIOP. So the processes that fall under the SIOP umbrella are simply demand planning, inventory planning, supply planning, and then this executive SIOP process that wraps around the whole thing. So it's fairly straightforward. So to understand when to order your raw materials or finished product if you're a distributor, and when to schedule production so that everything comes together in time to meet your customer orders or to meet your inventory goals, you have to have visibility into demand. So it starts with a good demand plan, and that means, most people probably know what that means, but just to put a finer point on it, that means a forecast typically from historical information and a statistical routine to forecast that out going forward. And equally important, and in a lot of industries, a lot more important, integrating that forward-looking insight into demand from the sales team and from customers. And then you need an inventory plan that takes your demand rate, your variability of demand into account, your supplier's lead time and the variability of the supply into account so that you can build and maintain the right amount of inventory of raw materials and finished goods, meaning your cycle stock and your safety stock, so that you don't stock out or overinvest in inventory. Then in supply planning, obviously you need to place your purchase orders on time to line up with customer need or to line up with your production schedule, depending on whether you're a distributor or manufacturer. And you need to schedule your production to line up with customer promise dates, and importantly, to line up with your available capacity in the factory if you're a manufacturer. And then finally, you heard Philip talk a lot about this overarching executive SIOP process, which is a regular routine or meeting that's used to ensure that finance, sales, and operations are constantly aligned on what they're going to buy, build, and sell, as exceptions come up in particular, meaning a launch of a new product, ramp up of a new customer. In COVID, we saw a lot of this when Chinese suppliers were temporarily shut down. How are you going to change your production routines, your buying routines, et cetera, to satisfy your customers as much as you possibly can as these crazy changes happen? And that's the overall importance of that executive SIOP process.
Great, thanks, Scott. Our next question is for Philip. Philip, as low and mid-range manufacturers' ERP systems, or MRP, drive supply to meet demand, what levers or settings within the MRP module are you analyzing to ensure it reflects SIOP planning?
Wow, that's a great question. And that's a really interesting one, because when we get in and we start looking at these smaller mid-market manufacturers, we oftentimes do see quite a bit of issues with respect to settings in the MRP. Most often, the biggest issue that I would say we see more than anything is a function which is either the direct MRP tied to sales orders, or it would be a work order almost acting like a sales order, in that whatever the demand is, it's equalized, it's reflected as a work order. And so basically whatever the request is what becomes the purchase or the procurement setting. So I have an order, 3 weeks from now, 4 weeks from now. The date of delivery is 4 weeks from now. So then MRP backs it up a week, and we procure to 3 weeks from now. Meanwhile, we're 12 weeks past due and backlog, right? That we see that all the time. And it's either a function of the setting itself, where we've got the MRP procuring to that sales order, unfortunately, or even sometimes when we have a preferred work order setting, we're procuring to a work order that's really still acting like a sales order. It's not an actual plan of future work that's balanced, that's taken anything that's past due and moved it forward, but instead we're procuring to this sort of infinite capacity type environment. That would be 85% of the opportunity we usually see. We do still see some opportunities with respect to items that aren't being closed out of a work order or a sales order that are still driving requirements, for example, to procure to. And so obviously we've got to go through and understand how long the allocation is going to sit for. We see issues with allocation and forecast consumption, where some piece of a forecast is answered by an order, but it's only equal to 15 or 20% remaining, but that 15 or 20% remaining isn't eliminated, so that holds a claim to MRP. And then, of course, the classic is that you've got, you know, a consumption quantity, a quantity of purchase with your suppliers that is an MOQ that's 10 times the amount of this remaining little piece of demand, whether it's coming from the forecast or it's coming from a plan of work that doesn't fully get finished. All these are serious drivers of potential issue. And of course, whenever we're doing our diagnostic, we're looking very closely at the settings and MRP. We're looking at the practices and processes that are in place and understanding any gaps related to procuring too much or the wrong types of inventory against what are really your actual plans or capabilities in order to manufacture. I hope that answers your question.
Great, thanks, Philip. As a quick follow-up, how long does a typical diagnostic take?
So it always depends. Of course, that's the classic answer. But on average, our diagnostics are 2 to sometimes 3 weeks. It would depend on the number of facilities, how big the business is, how dispersed they are, et cetera, et cetera. But if it's a standard $100 million business in one location, inside of 2 weeks would be 90% of the time.
Great, thank you. So Scott, what do you think has changed in the last 5 to 10 years to give companies a leg up from an SIOP standpoint? And how did that equation change as a result of COVID?
Yeah, so there are 2 questions packed in there, so let me hit each one of them in sequence. So what's changed in the last 5 to 10 years? I think there are 2 main things from my perspective. If you go back 10 years ago, the whole idea of SIOP, it was there, the basic routines were there, the inventory planning, statistical routines to figure out how much inventory you need to meet your customer demand were all there. But I think it was rare that all the pieces were integrated really well. And so, you have now these things that have been shaken out over such a long period of time that, the way that the demand planning, the inventory planning, the supply planning work together are so much more sophisticated and streamlined that the overarching process is so much more effective. I know that's a pretty general answer, but it's really come with cycles of repeat over and over and over again that have refined this thing that was nascent 10 years ago. When it comes to the tools, that's another big thing that's changed. Is that we spend an awful lot of time putting in place the right processes in each sub-function in SIOP, but to industrialize those processes, and particularly all the math on the back end. If you think about what does it take to have to get a clean forecast, an integrated forecast with your historical demand patterns and your forward-looking info, and then figuring out the variability of the error in that demand. That's really what drives your purchase orders. And so, in the past, when people used to do this on spreadsheets, that was a tough thing to do. You've got these sort of statistical formulas that are running around to estimate your variation in variability in demand, which took a long time. And then you typically drive your inventory planning algorithms off of that variability in demand. Now you can automate that whole process. All that math on the back end, there are just great tools that have come down in price so significantly in particular over the last even 3 or 4 years, or even 1 to 2 years. For mid-market companies, there are very low-cost solutions that industrialize and encapsulate this whole process and make sure that it happens every single month. And in fact, on a day-to-day basis now, these things run so frequently, consistently, and the same over and over again. So that's another kind of big driver of the ease in which it is to put these things in place, and sort of take it out of the spreadsheet mode where in the past there were so many opportunities for error. I think there's another question packed in there around how did that equation change as a result of COVID. I don't know that the SIOP routines and equations have changed much. You know, I think it's really that really, you know, COVID really highlighted the need for well-functioning SIOP. You know, we saw a lot of demand on our side from our clients who needed help fixing and improving their SIOP processes as a result of COVID. You know, we also saw that earlier. You know, when the current administration had put the tariffs in place, and you know, we had massive price swings and shifts in where supplies were coming from. You know, any of these discontinuities really put the SIOP process to a test. And the COVID thing for sure. You know, you're completely, in a lot of cases, changing where your supply is coming from. The length of time that it takes to move your supply from your current, you know, all the delays that have come into play because factories are shut down, et cetera. You know, completely changed cycle stocks and safety stock requirements in inventory and a lot of the other elements of SIOP. Let's see, is there anything else important? And then I guess, you know, the other thing that comes into play here, as Philip said, is that SIOP becomes almost like a place where you can play out in advance or simulate what's going to happen. So, you know, when you start thinking about solutions, COVID came along, big discontinuity. What are we going to do about it? You know, people with strong and high-functioning SIOP routines were able to take a step back and say, let's figure out what the right thing to do is here. Should we take a gamble on our current suppliers in China, for example, and figure out how long it's going to take them to get back on their feet? Or should we consider pulling that closer? You know, we've always thought about moving it to Mexico, for example, where labor rates are on par with China, but our lead times are, you know, weeks shorter. It allows you to kind of simulate and look at the impact on your inventory and on your ability to service your customers, you know, in putting in place a complete change in your supply chain. So hope that answered the question.
Great, thanks, Scott. I think we have time for one last question. So perhaps this question for Philip. So where do you think SIOP should sit in operations and sales and finance? Where does it fit functionally?
Yeah, that's an interesting question and a good one. Traditionally, it sits in the office of the chief operating officer, probably 80% of the time. But there are some instances and cases where having that role or that function sitting, you know, in finance or sitting in sales might provide some additional benefits or unique benefits. At the end of the day, though, the person that is running or the team that is running the SIOP routine or sales and operations planning or integrated business planning really has to be a little bit unbiased, has to play a little bit of a referee role where you're supportive of sales, you're supportive of operations, but you're not taking a side, right? Your ultimate customer is our end customers. It is our stakeholders or our investors. It's our manufacturers, the people that are running out and doing the work. It isn't necessarily a functional role. It's sort of cross-functional, if you will. As long as the person is in there and the person or the team is able to translate what is the language of sales into what is the language of manufacturing and push those back and forth, then you're going to have a successful person or team in that particular role, no matter what department they're sitting in. So, for example, you know, sales is thinking dollars. Manufacturing might be thinking pounds or units or OEE, but being able to walk a dollar's worth of future demand into units of required capacity on line 1, 2, 3, you need to be able to do that. You need to be able to do that seamlessly in the routine. And so that's, you know, that's where the capability comes in. That's where the development comes in. But where the role ultimately sits isn't that critical, but it usually does sit in the office of the COO.
Great, thanks, Philip. So if you find yourself with a follow-up question from today's webinar, please don't hesitate to reach out, as sales, inventory, and operations processes can be difficult to evaluate. Trivista has specialized expertise and processes. If you would like to discuss unlocking value with SIOP improvements, connect with us. We can illustrate the financial gains that your company or your investments can derive through this powerful approach to transformational improvement. Thank you for joining us today. As a reminder, a recording of this webinar will be available on the Trivista website. We also have additional information on SIOP for your review. As you exit the webinar, you'll be asked to share your feedback. Please take a minute to give us your comments, as we greatly appreciate your input. On behalf of everyone at Trivista, thanks again. Care. Have a nice afternoon, everyone.